If you own an investment property and you sell it, you could owe a huge portion of that profit to capital gains tax unless you know about this one IRS rule. It's called a 1031 exchange. And it's one of the most powerful tools real estate investors use to grow wealth without losing money to taxes every time that they sell. I'm going to break down exactly what it is, how it works, and why more investors are looking at markets like Galveston to do it. So let's dive in. The 1031 exchange, named after Section 1031 of the IRS tax code, lets you sell an investment property, roll those proceeds into a new like-kind property while deferring the capital gains tax that you would normally owe. The key word there is defer, not eliminate. You're not avoiding those taxes forever. You're just pushing them down the road, which lets you keep the full profit working for you instead of just going to the IRS today. Like kind sounds pretty restrictive, but it's actually broad. It just means real estate for real estate. So you could sell, say, a rental condo and buy raw land, a duplex, or a commercial building, whatever, as long as it's held for an investment for your business, not personal residence. Here's where people get tripped up. There are strict timelines and requirements to follow after you sell your original property. You have 45 days to formally identify potential replacement properties, and then you have to close on that new property within 180 days of the original sale. So you cannot touch the sale proceeds yourself. A third-party intermediary holds the funds between the sale and the purchase. If the money ever hits your bank account, then the exchange is disqualified. To defer 100% of the tax, the replacement property needs to generally be equal to or greater in value and debt compared to what you actually sold. These rules are non-negotiable with the IRS. So anyone considering this needs to line up a qualified intermediary and ideally a CPA before you even list your original property. So why am I bringing this up on a Galveston real estate channel? Because I'm seeing more and more 1031 investors specifically targeting coastal markets like ours, and it makes sense. Short-term rental demand on the island stays strong nearly year-round. Beachfront and near-beach properties have historically appreciated well as vacation and investment inventory. Compared to a lot of other coastal markets in the US, Galveston still offers a relative value for investors, rolling proceeds out of more expensive metro areas. If you're in the middle of a 1031 and the clock is ticking on that 45-day identification window, having someone who actually knows this market, flood zones, insurance, considerations, rental performance by the area actually matters a lot. And that's exactly the kind of thing that I help clients navigate. A few pitfalls that I see are waiting too long to line up a qualified intermediary. This ideally needs to be done and set up before your sale closes. Another is underestimating how fast that 45-day window moves, especially in a competitive market, as well as assuming any property qualifies as a like kind without actually checking with a tax professional first. None of this replaces the advice from your CPA or a 1031 intermediary, and I'm not either of those, but if you're weighing whether Galveston makes sense as your replacement market, that is where I can step in and help. If you're sitting on an investment property and thinking about a 1031 exchange, or you've never heard of one of those until this video and want to understand if it fits your current situation, be sure to drop a comment or reach out. I'm happy to talk through what the Galveston market looks like currently for investors. If this video helped you, make sure to subscribe because every week I will be sharing what you need to know about buying, selling, and living in Galveston. I'm Marquez with GTX Realty Group, and I'll see you next week.